Let's check the markets here. Got a pretty good day going. We're basically at the highs of the day. There's the Dow, good for near 1%, 270 or so. S&P is over that level, as is the NASDAQ. I would offer up maybe the most impressive thing that's been going on lately. The Russell 2000 is pacing for a 5-day win streak. So if you're bullish on the economy, you think we're going to have a soft landing, a really beaten up area of the market, small caps, nice boost today. Got oil stabilizing, the 10 years the lowest in a week. And Josh Brown, that to me is the big story today, but pick yours.
I think yields and I think the steepening in the bond market is really it. I think you nailed it, Judge. Yields today are down for every duration, and actually in the belly of the curve is where you find them down the most. The 5-year, the 7-year, both down 14 basis points to 4.6 and 4.65% respectively. Think about all the steepening that we've seen in that inverted yield curve, uninverting right before our eyes on an accelerating basis. The 10-year, 2-year spread is now 30 basis points, 0.3%. It's the steepest we've seen the curve since October of 2022, 1 year ago. So we have done a lot of work in the bond market. The 10-year 3-month, which is what Campbell Harvey used, is right now negative 85 basis points. Remember, that was almost negative 2% in June of 2023. So we have made a lot of progress. And then you think about the stock side of the equation. You have an S&P 500 currently trading at an 18 forward PE, mid caps at a 13 forward PE, small caps 12. S&P growth is still 20 forward PE. If people are talking about, oh, the market's undervalued or hasn't come down enough, that's what they're talking about. S&P value is a 16 forward PE with a steepening yield curve. I think we're in a good situation right now between now and year end. I like the strength that we're seeing in leadership, and I like where valuations stand.
I go back to Jimmy Goldilocks, right? That's what we talked about the last time you were on, because the market is reacting as if that may be the case, or it's trying to buy into that story. Whether it holds or not is anybody's guess, and earnings are going to be a good tell on that, the movement in yields, et cetera. I got the NASDAQ 100 above the 50-day for the first time since September 15th. NASDAQ's up 4.5% in a week. So, I mean, you could pick your spots of where what would be perceived to be more bullish signals are coming from. Yields down, small caps up nicely along with the NASDAQ.
So when last we talked, Scott, it was Friday, that Goldilocks jobs report, and that was a very good, for me anyway, fundamental reason why the market should rally, and it did. Now, the last 2 days, I think the market has rallied primarily because of yields coming down, but I don't like why yields have come down. It's this exogenous issue in the Middle East, which is on a human level just beyond tragic, but it's not a fundamental reason to me why the market should be rallying. I understand rates are down. Hang on, Josh. Let me just flesh this out fully, if you will. To use your term, let me cook. Where you get more fundamental backing for this rally, in my opinion, is Thursday. If you get a CPI that comes in softer than expectations, right? Headline right now, it's expected 3.6%. Core is 4.1% year over year. You come in below that, this market is, I think, then going to put to bed the idea that the Fed's raising rates anymore. And if the Fed is done and the market grasps that, then what the market is going to say is this economy is strong. This economy looks good. Look at the labor market. Look at where GDP is estimated. Look at ISM manufacturing bottoming, clearly coming out of the recession it's been in. And there's a lot to be bullish. That would then be backed up by earnings. But the sine qua non for me right now is Thursday's CPI. That's the fundamental factor I'm looking for.
Okay.